Welcome back to the Catalyst Clock. Quick note, not financial advice, we're not licensed advisors, educational analysis only. Netflix stock is currently down 46% from its all-time high, as investors weigh an increasingly competitive landscape and the recent departure of the company's co-founder Reed Hastings, who was serving as chairman of the board. And in exactly 7 days, its Q2 earnings report could decide which direction this goes next.
A stock this beaten down, with a hard deadline this close, that's exactly the kind of setup we track here.
Here's what's changed. Netflix walked away from 2 major acquisition fights, a potential Warner Bros. Discovery deal and rumored NBC Universal talks, and that decision reassured investors that management wasn't about to overpay and take on integration risk.
That walk away actually paid off directly. Netflix collected a $2.8 billion termination fee from the Warner Bros. Situation, which helped the company raise its full-year free cash flow guidance to roughly $12.5 billion, up from an earlier $11 billion estimate.
Meanwhile, the ad-supported tier keeps scaling. In ad-supported markets, that tier accounted for 60% of all new signups, and Netflix ended last quarter with 4,000 advertising partners, up 70% year-over-year. Management is guiding advertising revenue to roughly double to $3 billion this year.
The stock currently trades around $77, well off its 52-week high of $129.50, though it did bottom near $70.86 before this recent bounce.
Here's the number that might surprise people. Based on Wall Street's average 2027 earnings estimate, Netflix now trades at a forward P/E of just 19.1. This stock's P/E was above 30 for most of the last 5 years. On a historical basis, that's genuinely cheap for this company.
For Q2 specifically, Netflix guided to $12.57 billion in revenue, 13.5% growth year-over-year, with a 32.6% operating margin target. That report lands July 16, 7 days from today.
Now the part that should temper the "it's cheap, just buy it" instinct. Netflix insiders have sold company stock 42 times in the past 6 months, and made 0 purchases. Reed Hastings alone sold across 18 separate transactions, offloading over 2.4 million shares for an estimated $223 million.
There's also a content problem developing. Netflix's biggest shows are reportedly losing 30% to 70% of their audience between seasons, and retail sentiment has cooled sharply alongside it. A real engagement crack underneath the subscriber numbers.
And there's a legal overhang worth knowing about. Netflix is facing a lawsuit from the Texas Attorney General alleging deceptive, unauthorized collection of children's behavioral data. That's a real regulatory risk sitting in the background of this story.
Prediction markets are skeptical too. As of this recording, bettors are assigning only about a 6.6% probability that Netflix trades back above $100 by the end of this month.
So, cheap by its own historical standards, raised cash flow guidance, a growing ad business, against zero insider buying, cracking engagement, and a pending lawsuit.
I'd put this at a 6 out of 10. The valuation argument is real, not manufactured. A forward P/E in the high teens for this company is unusual. But when literally every insider transaction for 6 months has been a sale, that's not nothing, regardless of how good the valuation story sounds. This is a wait for the actual July 16th print stock, not a buy the week before earnings stock. That report is the real catalyst, not this video.
The bigger question, when a company's own executives are selling every single transaction for half a year, but Wall Street keeps saying, cheap, buy it, whose read on the business would you trust more?
That's what we're watching for on July 16th. Subscribe so you don't miss the verdict.